catch up. All right. It's 11:32. Thank you so much for joining, everyone. It's my pleasure to welcome everyone joining us here today to learn more about AngelList's Demo Day funds for the YC Winter 2023 batch. For those of you who aren't familiar, Y Combinator is one of the world's largest startup accelerators. YC hosts a demo day twice a year where founders present their companies to a select group of investors. In fact, not so long ago, companies that are household names today, such as Airbnb, DoorDash, and Instacart, they were once presenting their products and services at a YC demo day. And over the years, AngelList has had the honor and the privilege to work with a talented number of fund leads, all YC alum, all successful founders and investors in their own regard, in order to offer you the opportunity to invest in these demo day companies. However, rather than investing in these companies directly, every year we spin up 5 funds, each run by a distinct fund lead, in order to provide a certain degree of diversification. And it's exactly this ability to diversify your investment across multiple underlying funds that makes AngelList Demo Day Fund so unique. Of course, none of this would have been possible at all without our esteemed fund leads. So please join me in welcoming our fund leads for this batch. Divya, Chris, Ben, Ethan, Colin, thank you so much for making the time to speak with us here today. We're all very excited to have you learn about your investing backgrounds, your experiences, and how you approach this year's demo day. So to kick things off, why don't we start with a brief round of intros from our leads? And Colin, let's start here with you. Can you please do the honors?
Yeah, sure. So I'm Colin Wallace. I'm a 3-time founder. I was in Techstars, the class summer of 2010. I was YC, winner of 19, and Google for Startups, and winner of 21. This will be my second fund this year. I am a managing director for Techstars in Silicon Valley, so I see lots of companies in general very plugged into the ecosystem. I also teach the Startup Garage program over at Stanford at the Graduate School of Business, which is ironically where DoorDash started, and Guild Education, Clear Metal, and so on, sort of pre-YC. So had the opportunity to see companies from a lot of different angles. Looking forward to working with the rest of the team.
Thanks, Ben. Ethan?
Hi, everyone, for joining late. I'm Ethan Perlstein. My company is Perlara Winter 16 batch. I invest in biotech companies in the YC portfolio, and that's kind of runs the gamut from kind of traditional biopharma to synbio to digital health and sort of everything in between. I've been investing since summer 19. So kind of saw the 2021 bubble period and now see us on the other side of that. I'm sure we'll talk about that and kind of valuations, everything come back to earth. But my thesis is pretty consistent no matter what. I look for scientist founders, kind of like my profile, and basically folks leaving grad school or their postdoc or even their professorship, or maybe even earlier in their training to start a company. So I really want to invest in scientists who become great CEOs and great entrepreneurs.
Thanks, Ethan. Let's go to Divya next.
Hey, everyone. I'm Divya Bhatt. I actually just wrapped up 2 batches as a visiting partner at YC, so have some of that fresh in my mind. Prior to that, I was a 2-time YC founder. So I did YC in 2006, so like 100 years ago. I had a music startup called Jam Glue. It was the largest online music remixing community on the internet in 2006. And then slightly more recently, I did a company called Rickshaw in winter 2014, and it was a mess of a logistics company that we thankfully sold to DoorDash in 2017, where I spent about a year leading product. Most recently, before I was at YC, I ran product and engineering at a company called Verta Health. I joined at the Series A stage and was there through a period of rapid growth around the time that the company raised a Series D. So I saw a bunch of rapid scaling and have been really focused on digital health ever since then, which will probably be part of my investment thesis, which we can talk about later. And I've been doing some angel investing alongside a bunch of other YC alums for the past 10 years. So looking forward to working with everyone.
Thank you, Divya. Chris?
Sure. Chris Golda, participated in YC in the summer of 2008. There's a company called Backtype, SaaS analytics company that was acquired by Twitter, where I ended up leading the ad center as Twitter scaled from basically $0 in repeatable revenue to over $1 billion, went public, grew to 3,000 people, et cetera. I'm an investor in over 100 startups. So startups like Benchling and Coinbase, also an investor in a lot of VC funds. So in general, just been involved in Silicon Valley for a while now. This is my eighth batch fund. Same strategy of sort of high concentration, non-thematic investing that I've been doing with a bit of a bias towards B2B. So nothing changing there.
Thank you, Chris. And last but not least, Ben.
So I'm Benjamin Bryant, behind two YC companies, was a music marketing platform called Earbits. And then I was the founding marketer at Pebble Smartwatch. We're the company that created the smartwatch. I've been, I guess, in the startup space for about 14 years now. And prior to that, I was at two hedge funds doing high frequency trading. Let's see, I've got a bachelor's in computer engineering and film, and then a master's in finance from London Business School. This is going to be my second demo day fund. Did one in 2017, one in 2021. Both of those funds rank in the top 10% according to PitchBook's venture benchmarks. And I guess apart from the fund here, I'm currently leading the small Android phone project, which is a community of about 40,000 people out to build the perfect Android-sized Android phone. So thanks for joining, and look forward to chatting a little more.
Thanks, everyone. Pleasure to have all of you. So love to hear about your backgrounds. Next, we'd love to hear more about your investing philosophy, how you approach investing and what you're looking for in companies in this batch specifically. To keep everyone sane, we'll go in the same order. So let's start with Colin again.
Yeah, sure. I'm happy to take it away. As the macro conditions have changed, we've evolved our thesis to be, more concentrated investors in sort of high conviction sectors. Specifically, I'm focusing on applied AI, fintech, and developer tools. So I think it's, again, more important to be a little more concentrated now, given the amount of scrutiny that we need to push onto companies in the current climate. With artificial intelligence, one of the things we realize is that we have unique access to the profound professors and alumni through Stanford University. Many of you remember that a lot of the tech that a lot of what we see today is seeded on is, sort of derivative of Dr. Fei-Fei Li and Andrew Ng and Sam Altman and so on. So being able to tap into that, I think, is actually a pretty not proprietary, but a unique value proposition for our founders that's sort of borne a lot of fruit for us. On the fintech side, we have a large base of emerging African and Latinx founders on the fintech, who are sort of rebuilding the rails for those emerging economies. So our intention is to kind of lean into that, using them as a reference base. I think they've been very fruitful for us in the past, so we want to just keep building on that. A lot of them are alumni of Flutterwave, of Paystack, Chipper Cash, you name it. So being able to springboard off of that as those economies continue to grow and emerge, they're a little bit insulated from some of the macro conditions that we see in other places. Lastly, with developer tools, we're still seeing a pretty significant constraint on the supply and demand for top-notch developers. And we believe that scarcity is going to continue to place a lot of pressure, on developers for automation, for no code, for productivity tools. And so we're going to be super opportunistic, finding companies who are building in those areas. Ironically, a lot of them are actually leveraging AI, sort of NLP as well. And so there's some pretty good synergies, I think, across the overall thesis. The last part is, in the last fund, we were really effective, I think, at deploying early and getting sort of preferred valuations. 80% of the capital we deployed happened prior to demo day, wasn't necessarily waiting for demo day. And so that's been effective for us. We haven't seen any markdowns. This is S22. Haven't seen any markdowns there. And we've had one markup in sort of, I don't know, what was 6 months since that was deployed. So I think that's a pretty strong strategy of just going in early, adding a lot of value for founders and using that to, get, early treatment or preferred pricing. And again, we'll do sort of 4 to 6 investments is our goal in this fund, and sort of high conviction, high concentration.
Thanks, Colin. Ethan?
So yeah, as I said, my thesis is pretty straightforward. I'm the only lead here is really focused on the bio companies within the batch. That's really my thesis. And so, as I said, my process is relatively straightforward in terms of the founder profile. as has kind of been the dynamic over the last few cycles. As fund leads, we're able to kind of get in early before demo day. And yeah, I don't know the exact number, but majority of my funds are also deployed before demo day. If you're kind of waiting for demo day, you're kind of potentially missing out on some of the better valuations. Some of the companies I've invested in, obviously biotech takes a lot longer to kind of incubate and for markups to show up. But one of my top performers so far is a company from the S19 batch, Asher Bio, which is an immuno oncology company. Probably would have gone public already if the markets hadn't closed, but so it takes a few more years for the biotech companies to mature to that point where they're even considering an IPO, let alone Series A or B. But I would say most of the companies that I target have raised Series A now and are on a path to basically develop some kind of a platform technology, and some of them are even working their way into the clinic. So I'd say I tend to focus during the kind of heydays of 20 and 21. It was hard to be disciplined, to be honest, and there were a lot of too many investments sort of not to pass up. And so things have gotten a little more disciplined, but I'd say I'm looking to make around 8 to 10 investments, probably usually in that 100, 125 minimum now. I tend to shy away from those lower check sizes that kind of happened in the party rounds of the previous years, but I want to be more focused now. And I've started to do that in summer 22, and I'm doing higher value checks. And some of the bigger checks would even be a couple $100K, in some cases trying to even match the standard deal for 1 or 2 companies in the batch. But yeah, I think otherwise my process is probably very similar to all the other folks in their verticals. But again, my focus is strictly on the bio companies in each batch.
Thanks, Ethan. Divya?
Yeah, so investment thesis wise, I think because I'm fresh out of being a YC partner, I think I have a lot of those heuristics built in. I'm looking for strong founding teams that are technical, that can make progress on their own without having to hire, especially in this climate. I really look at a scrappy mindset, right? People that can tighten the belt if needed, but are not afraid to deploy funds when they have it. Like I feel like that's a tricky balance that I personally have sometimes gotten wrong in my startups. So I look for that. A really good business sense. Do people understand unit economics? So they understand how CAC and LTV work? I'm not necessarily looking for those to be working in their business right now, but I think it's always important to hear how founders think through some of those things and do they have the ability to do that as needed and when it's needed. I love supporting underrepresented founders and women. I think they're often twice as good as their peers and usually overlooked. And I think because of my background, like a lot of others on this call, I think I often get special access to some of those deals before demo day. So I'm probably going to be looking hard at some of those groups. And I think lastly, from my YC partner training, I always index really heavily on founders that can pivot when needed, but in particular, folks that can really listen to their users. And that's something I look for is do these people understand their users? Are they solving a real pain point? Are they asking leading questions or are they really listening? And I guess lastly, I tend to be pretty space agnostic, but biased towards spaces I know better when I can. Digital health, logistics, B2B SaaS, and dev tools are probably the places that I tend to most heavily focus, but no hard and fast rules on that.
Thank you, Divya. Can we go to Chris?
Sure. So my investing philosophy is pretty simple. It's focused on picking great founders. So been doing this for 10 years. I've developed a process that basically tests founders and helps me identify the ones that I think are best. So, I'm looking for things like high tolerance for uncertainty, sort of independent thinking, dedication, persistence, kind of evaluating their motivations, identifying a strong sense of urgency and bias towards speed, different things like that I test for through my own process. It's not thematic in any way. There's no sector focus. I literally just invest in what interests me with a bias towards B2B, basically because that's my background. And I'm not really looking for specific companies or specific products. I believe it's the founder's job to invent the future, not the investor. And so my job is simply to identify the best founders.
Nice. And Ben?
All right. So my background is quantitative finance. So I take a slightly different view to this, but my position really is that portfolio theory applied to venture investment is going to win. And I guess what I mean by that is kind of a bit of a simple observation that if you look at things quantitatively, the more early stage companies you invest in, the lower your risk is going to be and the higher expected returns are going to be. It might be an innocuous point, but there's something really interesting when you look at early stage companies versus later stage companies. And it's that the winners win big, like really big, and will compensate for kind of any drawdowns on the rest of your portfolio. And so in this framework, what it really means is your biggest worry is not so much that you're going to make bad decisions around here, it's that you're going to miss out on the great opportunities. So my whole philosophy behind this is get exposure to as many areas as possible. So as many markets, sectors, geographies, business models, so forth, and really build a broadly diversified portfolio with that. And, when I mean broadly diversified portfolio, our W23 fund invested in 50 companies out of the batch. So in terms of factors, we're looking for tenacious founders, people that are dedicated, like that's really what wins in this game. And then for every company, we'll go through all the company of the batch and essentially build a thesis around how does this company get big in its current stage. And then if we don't have ones that we've seen and made a clear path to doing so at that point inside, we'll exclude that. Or if we haven't seen a company that's made kind of meaningful progress during the program. And beyond that, we compose our portfolios. And then I guess the only thing I'd add beyond that is I tend to be one of the few Demo Day founders that invests in high capex and hardware startups. Partly that's because I have operational experience in that background, but I'd say it's also because this broad portfolio model supports and encourages doing so. And that's actually turned out pretty well. So, in summary, we invest in, broad, diversified, big portfolios. There's a strong kind of quantitative reasoning that underpins that. And so far, it's actually worked out very good for previous funds.
Thank you, Ben. Thank you, everyone. Awesome. Always enjoy hearing, the different approaches we have in the room. Next, we would be remiss if we didn't address the topic of the macro headwinds. So given what's happening in the tech and startup investing world, how are you guys adjusting your investment philosophy this time around? In other words, what's top of mind for you as we enter what some may categorize as a very different investing environment than what we've had for the past 5-10 years? And, I'll skip the person by person kind of pointing and just allow anyone to jump in just in the interest of time.
I can hop in if you want. So I guess, I look at it from perhaps a bit of a different perspective. Markets are designed to price in risk. So if we look at last batch, I think summer valuations were down maybe 20 to 30%. And that's, decreased to compensate you for the shift in economic outlook. But, the takeaway I also say from that is that we're looking at the YC companies are still getting funded rather in there. And the fundamental opportunity that comes from them is, still there. And then I'd also say, there's been a lot of discussion, but we're looking at a very different class of company. If you're Brex and you want to exit in 2023, all right, you do have a problem. Your $12 billion valuation is going to need some form of cheap credit to underpin that. But that's not the game we're playing. We're not looking for big exits tomorrow. We're looking for, exits 6 to 10 years from now. So, the companies that are founded today are going to be reaching their zenith, I guess, once, the economy is picked up and back in its full kind of upward swing. So, beyond that, I don't think the fundamentals of investing actually changes. And I also think, the markup of YC is going to shift a little towards, what is amenable for this. And I guess the last point I'd make, if we're looking at a comparable, right, 2009 is an interesting time to look at. We've right in the middle of the worst, credit crash ever. 2 investment banks have failed. The government has practically bailed out the entire financial industry. And then, what are the 2 companies that came out of YC that year? It's Airbnb and Stripe. So 2 of their most valuable ones. So, I'll leave you with that, but I, say that, in investment, it's often, a well-founded contrarian viewpoint that tends to win big.
Yeah, I'm not seeing, as far as prices go, a huge divergence from, last year. I think late stage has had large markdowns, but seed is relatively consistent. And I think this is supported by AngelList data. I think the median valuation in 2021 was like 15 million at seed post money, and now it's around 20. And we've seen that quarter to quarter pretty much consistently in 2022. So I really don't expect to see much change. I think there were probably some trends that were overinvested in, remote work, et cetera, but, I largely ignored those types of things anyway. So I'm changing basically nothing to my approach. It's always been very high concentrated. So I've always been sort of valuation kind of insensitive. If I find attractive valuations, I get them because I'm early, but I'm not specifically looking for low entry prices. I think choosing 10 companies in a fund, I don't really need to care that much about my entry price. And so my model is sort of like works well in high price environments and works very well in low price environments. So I'm changing nothing. And I don't expect much to change like at the seed level relative to, what's going on macro.
Yeah, just to build on Chris's point, as well as Ben's point, one of the things I'm seeing as well is that sort of the aggregate caliber of founder is going up as people are entering that founder market from, whatever role they had at Google or at Meta or wherever it is. I think there's a lot of things that people have been working on sort of on the sidelines that are now becoming sort of more mainstream or their main focus. And so on a long term, I expect to see actually the sort of caliber of founder go up as more people come into the marketplace with sort of, again, a lot of the recent layoffs and so on.
At this point, sure.
Oh, sorry. Just jump quickly to say, from the science and biotech perspective, I think it doesn't really matter what the conditions are. Amazing scientific discoveries are made all the time. In fact, a lot of them happened during the pandemic without any slowing down of speed. So I'm less concerned, honestly, about macro conditions. The first year or first couple of years of a biotech startup or deep tech startup are spent kind of grinding away anyway. So it doesn't really matter what the macro conditions are. And in fact, I think the conditions are even riper now to find really great opportunities. And with the standard deal going up to 350K, it allows biotech companies in particular to have a little bit more breathing room. And it gives more leverage to someone like me to come in earlier to give them a boost before demo days. So yeah, overall, I'm not too deterred by macro conditions, and because science will always be building. Science will always be building.
Yeah, I mean, I don't have anything that much new to add. I mean, I agree that with the standard deal, I think that offsets some of the macro condition risk. And I think because of my background in logistics, I've always been a stickler for unit economics. So I think it's important now more than ever, but no big change on, my investment strategy.
Thank you all. Very, very enlightening. So we've got an interesting question from the group here. Has YC become more or less selective in terms of acceptance standards over the past decade? And how has that evolved, in your opinion?
I think the top of the funnel has increased, right? So I think while you might see the percentages having changed, I think the quality bar remains high and has always been high. I think as far as I've seen, the different types of companies that do YC and get into YC vary. I don't know if that's necessarily like a higher or lower quality, but you will see companies at a variety of different stages all around the world. I think YC tends to find new markets and be leaders in those spaces. Nigeria, Latin America, India tend to have Southeast Asia tend to have growing population. So I don't know. I mean, I'm curious to hear what others think, but I don't know if the bar has necessarily changed. I think it's more qualitative than quantitative.
I mean, I think the mix of companies have shifted. I mean, to your point of international expansion, that's really in the past, 3 to 5 years has been very distinctly different than it was back in the day when we were going through it. And the batch size has increased. But what I've always seen is, YC is very numbers and driven. They'll try something. And then, if there's something that's, a little shift, they'll revise and then slowly progress towards kind of expanding the point. And they've really managed this point in time to figure out how to scale to, the number of companies that are going to batches, because it's really, it's more, that's a product of, there just are that many great founders out there, and YC can enable them to change the world.
Yeah, I think, YC's facing perhaps more competition, but they still have the best brand, period. And so they attract incredible founders. And I think the mix has changed over the years. Obviously, batches have grown, but so has the focus of YC. It's gone more international. It's expanded to different markets. In my first batch fund, I didn't do much international, and I didn't do any hard tech, and now I am. So, whether the batch is 100 companies or 400 companies, like I'm only really looking for 10 amazing companies, and there'll always be at least 10 amazing companies per batch. And that's been, consistent batch to batch. There's always been breakout successes, and I don't expect that to change.
Yeah, I think one thing I've noticed is just maybe it's just a function of aging into middle age from a younger founder, is that I see a lot of repeat founders that I never saw a couple of years ago. We already talked about the internationalization of the founder pool, but also the fact that you've got repeat founders. Obviously, the quality of a repeat founder is going to be intrinsically higher. So I think YC is just going to benefit from more and more of these repeat founders coming back, and so they're going to just come at a higher sort of the baseline will kind of just keep going up, in my opinion.
I think that's it, really. We have a few other questions in the chat, but they're really, around the logistics of investing. I think we're happy to call it here. Thank you so much, everyone, for joining. It's been a pleasure chatting. And for those of you who still have questions, please feel free to write into invest@angel.co or demoday@angel.co, and we'll make sure your questions are answered. Thank you so much, guys. We'll keep you posted with all the funds.
All right. Thank you, everyone.
All right. Thanks so much, everyone.
Good one.
Thanks, everyone.